Most people think the last few weeks were chaos. Gold down hard, silver absolutely smashed, credit markets wobbling, funds are blowing up quietly in the background. But here's the uncomfortable truth no one wants to say out loud. What you just watched wasn't the crisis, it was the positioning. Over the last month, gold slid almost 9%. Silver didn't dip, it fell off a cliff, down more than 25%. And while everyone was glued to price charts, one of the largest private credit vehicles on the planet quietly lost nearly a fifth of its value in a single quarter. That doesn't happen by accident, and it definitely doesn't happen in isolation. These moves are connected. They're part of the same system. And if you understand how that system actually works, not how it's explained on TV, you will realize the silver crash wasn't at the end of the story. It was the opening scene. Right now, there are three forces converging at the same time. Most people are either watching the wrong one or panicking about the wrong risk entirely. Let's fix that. First, there's this constant fear floating around about gold and silver being confiscated. Not metaphorically, literally, like it's 1933 all over again. That fear is understandable, but it's also misplaced. The real risks looks very different today, and if you're watching the wrong threat, you're leaving yourself exposed. Second, there's a private credit problem building quietly in the background. Not a headline problem yet, not a Twitter problem, a balance sheet problem. And when these go wrong, they don't fail politely, they cascade. And third, when those two collide, they create the exact environment where precious metals and select mining companies don't just recover, they reprice violently. But only if you know how to separate opportunity from noise. Let's start by clearing up the biggest misunderstanding first. Everyone keeps asking the same question. Will the government confiscate my gold like they did in 1933? That's the wrong question. It's like asking whether taxes will exist in the future. The answer isn't interesting. The method is. Back in 1933, confiscation worked because the system depended on it. The dollar was tied to gold. Banks physically held most of it. The government needed it to reset the system. So they centralized it, revalued it, and quietly transferred purchasing power away from the public. Today, none of those conditions exist. The currency isn't backed by gold. The central bank doesn't need your metal to print money, and physical ownership is massively decentralized. Home safes, private vaults, overseas storage, no registry, no practical enforcement mechanism. Even historically, people forget one key detail. Compliance in 1933 was terrible. Most people didn't turn anything in, and the government knew exactly how far they could push before things got unpleasant. So no, the dramatic door-to-door seizure narrative makes for clickable thumbnails, but it's the least likely risk on the table. The real risks are quieter, more boring, and far more effective. The modern system doesn't need to take your assets away. It just needs to make them inefficient to use. This is where stealth confiscation comes in. Instead of seizing gold or silver, the system simply taxes the outcome. Imagine silver triples. Gold goes to 5 figures. On paper, you've won. But when you go to convert gains into usable currency, the rules suddenly change. Windfall taxes, emergency levies, capital gains frameworks rewritten overnight. Not framed as confiscation, framed as fairness. Most people won't object, because most people don't own metals. And anyone who does will be portrayed as having got lucky. This isn't theoretical. Governments have done it repeatedly. With oil, energy, commodities, corporations, precious metals already face higher tax treatment than many speculative assets. Not because they're risky, but because they don't benefit the same lobbying structures. But even that isn't the end game. The real constraint isn't taxation, it's conversion. As physical cash quietly disappears and digital settlement systems take over, control shifts from ownership to permission. In a fully digital monetary system, you can own gold, but converting it becomes conditional, reviewed, delayed, flagged, taxed instantly, or simply discouraged through compliance friction so heavy most people won't bother. You still own the asset. You just lose flexibility. That's the part most people miss. Now, while everyone's arguing about confiscation headlines, something far more dangerous is building behind the scenes. Private credit. It sounds boring, which is exactly why it's dangerous. Private credit is lending done outside traditional banks. Hedge funds, private equity, asset managers, no public transparency, minimal oversight, enormous growth. And here's the key detail most miss. The money still comes from the banking system. Banks lend to funds. Funds lend to companies. Risk gets pushed outward, but it never disappears. When defaults rise, the pressure flows back upstream. Through derivatives, through guarantees, through exposure no one wants to admit exists. We've already seen early cracks, subprime auto lenders collapsing, industrial suppliers under strain, delinquencies rising quietly. And when one of the largest asset managers in the world takes a near 20% hit inside a private credit fund in a single quarter, that's not volatility, that's a warning. This is how financial stress actually starts, not with a bang, with margin calls, with forced liquidations, with sudden selling in unrelated markets, which brings us back to silver. Silver didn't crash because demand vanished. It crashed because leverage had to be flushed, futures margins raised, cash demanded, positions closed. This is how strong markets reset before moving higher. And when credit stress builds at the same time, that's when capital rotates into assets that aren't someone else's liability, gold, silver, and, for those who understand the risk, select miners. Not all of them. Not blindly, not emotionally. Mining stocks are leverage, powerful when used correctly, brutal when misunderstood. A well-run miner doesn't see profits rise linearly with metal prices. They rise exponentially. Costs stay relatively fixed while revenue expands. That's the upside. The downside? When prices fall, miners fall harder, which is why selection and risk management matter more than hype. You don't buy miners because you're bullish. You buy them because the math works. Costs versus price. Production growth versus depletion. Jurisdiction stability versus political risk. Balance sheet strength versus dilution risk. Producer versus developer. Most people skip those steps, then wonder why they panic at the worst moment. The real opportunity window usually opens when metals correct, leverage clears, and credit tightens. Exactly the environment we're moving into now. This isn't about predicting exact prices. It's about positioning before repricing. Physical metals remain insurance. Miners remain optional leverage, and information remains the edge. The silver crash wasn't the signal to exit. It was the signal that the system is under strain again. And historically, that's when the next move starts, not ends. If you take one thing away from this, let it be this. The loud risks get talked about. The quiet ones do the real damage, and the biggest moves don't start with euphoria. They start with discomfort. Stay sharp, stay diversified, and don't confuse volatility with failure. Because what comes next is usually bigger than what just happened.